While Budget 2026 didn't deliver any major revenue proposals, unlike most of the recent budgets, it remained firmly on track with the IMF program. It stayed focused on achieving long-term debt sustainability, ensuring that all the pieces are lined up for when we have to start making our heavier debt repayments from 2028 onwards, which is when our initial grace periods end and our lower coupon bonds start seeing step-up increases in interest rates. After an exceptional 2025, where revenue is expected to surge to 15.9% of GDP, above the 15.1% which was initially projected, this is particularly due to pent-up vehicle demand, 2026 marks a shift towards a more sustainable growth, with revenues supported by a broader tax base through lower VAT thresholds of 3 million rupees a month, a 2.5% levy on motor vehicle imports, and simplified tax structures to avoid loopholes. As a result, government revenue is projected at 15.3% of GDP, right in line with the governance-linked bond target, which can reduce our interest rate by 75 basis points from 2028. On the spending side, capital investment remains front and center, with 1.4 trillion rupees allocated, which is around 4% of GDP. This is allocated for expressways, housing, irrigation, and power transmission upgrades. And with faster tender awards being awarded over the last couple of months, these projects should drive real growth in 2026. At the same time, lower borrowing costs, with interest payments easing to 7.6% of GDP and a steady primary surplus, are expected to keep fiscal pressures contained, and as a result, lead to lower interest rates. The big winners of the budget are the construction sector companies with 104 billion allocated for expressway projects, the telco sector with a 5-year tax holiday on towers, and cable suppliers with transmission and capacity upgrades expected by the CEB. Overall, we believe the fiscal discipline provided in this budget, paired with targeted growth initiatives, will be positive for economic growth, equities, and interest rates.